A project has the following estimated data: a selling price of $57 per unit, variable cost of $32 per unit, fixed cost of $9,000, a required return of 12%, and an initial investment of $18,000 and a 4-year project life. Ignoring the effect of taxes, what is the accounting break-even quantity, the cash break-even quantity, and the financial break-even quantity? What is the degree of operating leverage at the financial break-even level of output? Let's go ahead and calculate our accounting break-even. Recall that an accounting break-even occurs when our net income is zero, and we can work backwards up our contribution margin income statement to calculate the required contribution margin and our break-even quantity. We were given our fixed cost of $9,000. Our depreciation expense is $4,500, which is our initial project cost of $18,000 divided by its 4-year life. This means in order to break even, we need to have a contribution margin in total of $13,500. Since we're selling our product at $57 a unit and have a variable cost of $32 per unit, our contribution margin on a per unit basis is $25. Thus, in order to break even in terms of units, we need to sell 540 units. This is our $13,500 total contribution margin divided by the $25 per contribution margin per unit. For cash break-even, again, we can set our net income equal to zero, but in this case we'll ignore our depreciation expense. This means we need to earn a total contribution margin of $9,000. This just covers our fixed cost. Our contribution margin per unit, recall, was $25. Therefore, break-even number of units is 360 units. This is the $9,000 total contribution margin divided by our contribution margin per unit. To calculate our financial break-even, first we need to calculate our annual operating cash flow. Recall, we have a 4-year project life. Enter 4 from the number of periods. Our required rate of return was 12%, and our project costs us $18,000. Enter this as a negative amount for the project's present value. We have zero salvage value at the end of the project, so put 0 for our future value, and finally we can solve for our payment. This $5,926 is our project's required operating cash flow at the financial break-even point. Let's go ahead and calculate our financial break-even point. We need $5,926 as our operating cash flow, and to get our operating cash flow we take net income and add back depreciation expense. Recall, depreciation expense was $4,500. This means we need to generate a net income of at least $1,426 on our project. This is our operating cash flow minus the depreciation expense. Our fixed costs, recall, were $9,000 per year. Our depreciation expense was $4,500. This means in order to achieve our net income, we need a contribution margin of at least $14,926. This is our net income plus our fixed cost plus our depreciation expense. On a per unit basis, we are making a contribution margin of $25. Therefore, our break-even number of units is 597 units. This is our contribution margin of $14,926 divided by our contribution margin per unit of $25. The degree of operating leverage can be calculated as 1 plus our fixed cost divided by our operating cash flow. Our fixed costs, recall, were $9,000 and our operating cash flow was $5,926. Therefore, our degree of operating leverage at our financial break-even is 2.519.